My name is Tom. I am the crypto investor, and today I want to talk a little bit about kind of foundational principles which we need to understand when we're investing. It's that time when there's a bit of fear in the market. I'm getting phone calls from people saying, should I be selling my position and buying back in again later when the market is lower? Well, that is timing the market, and we know that time in the market is better than timing the market. And I'll give you some good examples showing statistically why that is the case. That assumption is obviously based on this certainty that we're going lower, and we don't know for certain we're going lower. This afternoon Visa are announcing their earnings. Visa might say that they've just put $50 million worth of ethereum on their books along to go with their CryptoPunk. We've got Google next week. They may say that they've just made a position in crypto along with their new blockchain strategy. We know the space is growing. We can't time the market based on a new kind of certainty that things are going down just because we've had a pullback over the last couple of months in line with the macro environment of higher interest rates. Anyway, so I want to start with this quote that an investor's worst enemy is not the stock market, but it's their own emotions. It's the fear and greed that pulls us into making incorrect decisions effectively. We see it time and time again in the market. You have the market hits new all-time highs, Bitcoin's all over the papers, and people are phoning you up who have never invested before saying, shit, should I be buying Bitcoin? 65,000. And they buy in and get greedy. People add to their positions. People take out loans. People put more than they can afford to lose in. And then the market goes down. And people have overexposed themselves. People that have not done the research into what they're investing in suddenly lose conviction because they don't understand what they're buying into, and fear creeps in, and fear leads to selling, and that effectively has this kind of waterfall effect. And of course we know that the Warren Buffett adage of to be greedy when others are fearful. This is our time to be greedy and to be fearful when others are greedy. When there's maximum FOMO in the market, when my friends start phoning me up, that's when I need to be offloading my positions, to be honest. So it brings me back to the point that bear markets, if we do go into a bear market, maybe we go sideways for the next 3 or 4 months, then this is a wonderful time to be adding into our positions, to be dollar cost averaging in. This is the time to be greedy. This isn't the time to be offloading your positions. This is the time when the big, long established players are accumulating. So be greedy, not fearful. All right. And I wanted to talk about time in the market is better than timing the market. Time in the market is about remaining invested for the long term. Timing is obviously jumping in and out. And jumping in and out, well, first of all, it's exhausting to constantly be watching your positions, to be thinking, right, now's the time I'm going to be in and out. It's tiring, and it takes its toll on people. And also, are you a trader? Are you really a trader? Is this your full-time job? Some people are, and of course that's fine, but for most of you, you have your full-time job. You can't keep your eye on this all the time. So you have to tell yourself from the beginning, what is my strategy? Am I a long-term investor? Do I think this space is going from 2 trillion to 200 trillion in my lifetime? And if you've done your research and you've come to those conclusions, then great. You're a long-term investor, and you can keep on dollar cost averaging into your position, keep on buying into your position, not trying to duck in and out and time the market. No one has a crystal ball. No one knows if we're going up or down tomorrow with certainty. So don't try and kid yourself that you do and time the market. All right, let's give you some examples about timing the market and time in the market. So you've got these 3 different investors. This someone on Reddit put this together a few years ago. You've got terrible timing Tiffany. So what Tiffany does is every month she puts $200 into a savings account, and then when it's the absolute worst time to invest into the stock market, she buys. So where is it? Yeah, this is the first time she buys. This was 1987 on some Black Tuesday or something like that. And so she has the worst timing possible, buying into the market, saving in cash, buying into the market at the absolute peaks. Not the troughs, the peaks. So she buys at the very, very worst time. And then you have Brittany, who buys at the very, very, very best time. This is actually the 1987 crash or whatever it might be. So she puts her $200 per month into cash, and then when it's the absolute bottom, she buys. And so we have her positions here. And then we got slow and steady Sarah, who just dollar cost averages every month $200 into the market like a metronome. She doesn't care if it's up or down. And then we have the results here. So in blue, no surprises, of course, that the one with the worst market timing possible, Tiffany, has performed the worst. And by the way, they all started with, I think I checked it here, $184,000. Okay, so they all started with $184,000, and since 1979, 180,000 is now worth 646. So she's still well up on the market because she's actually put it into stocks instead of buying into just holding it in cash. And then we have Brittany, who buys at the very most perfect time. She has $900,000 instead of her 180. And then we've got slow and steady Sarah, who just dollar cost average every single day, and she's got 1.3 million. And the reason that she's got more, of course, than Brittany is that she was always in the market. She was never in cash. And so she was able to take advantage of the overall market moving up over time rather than buying just at these troughs. If you were to wait for a trough, for example, between 2008 to the COVID crisis, you were out of the market for a long time, so you weren't doing so well. So this is just a good example of why you want to be, the best way that you can invest is to just set yourself a monthly allocation, buy £200 worth of Ethereum or the BED index, Bitcoin, Ethereum, DeFi, every single month, and just keep on doing that for the next 10 years. It's really, when you look at it from, when you kind of, if in doubt, zoom out on the market, we can see that overall we are going up and to the right. The biggest mistake also people will be making is not buying during the bear market, but also buying way too much moonshot coins, which probably are going to zero. Don't forget that Bitcoin and Ethereum alone make up 60% of this total market. So as we say, holding quality is extremely important. Remaining invested for the long term is extremely important. And dollar cost averaging. So right now for me is not a time to be selling and hoping that the market goes lower to be buying in. Right now is an excellent time to be greedy. That's gold. What we want to just quickly look at is Bitcoin. And right now, if we do want to look a little bit more micro on this, we need to break this downward slope, and maybe we push lower, or maybe we go sideways for a bit. But I think if we just look at this over the last couple of years, we've got a high that was put in, and then we've got a low that was put in, and then we've got a higher high that was put in, which is what you want. And then right now, if we hold somewhere around here, then we have a higher low that has been put in. And this is great. This is really, really good. And it means that, we could be sideways for the next 2, 3, 4 months. Dollar cost average, buying monthly. And then probably we get something like this start to happen. And we come back up and we put in a new high. And then perhaps we come back down again. But we hope that we put in a swing low, which is higher than this one. And so goes the way for the next several years. And this is probably the kind of thing we can expect to play out. It's really is that simple. If you remain in the market, if you don't try and time the market, and you buy into robust investments that go up over time, then generally you win. But if you try to be too cute and clever and time the market, if you buy too much shit coins, and if you use leverage or overexpose yourself so you're forced to liquidate, then you lose. So I hope you found that useful. Obviously, this is in no way financial advice. I'm just a guy on the internet. But I wanted to share that with you. And yeah, happy investing, everyone. And I'll speak to you soon. All the best.